But if you could share with us what are some of the failed investment that you made, and what did you learn from those experiences?
Sure. Nobody likes failed investments, and it's very hard to know when to pull the plug on investments. Some of the typical reasons are, and one of the key is, are they at the right stage? Are they at the right stage with the right product and the market is ready? You have the best technology in the world, and if the market is not ready for it, you have to educate the market, and that's hard. That is hard and expensive, and takes much longer and much more cash than you would ever anticipate. So, companies think that the market is ready. They might have some early examples of that, but it can be very difficult. And look at quantum, look at cloud computing, look at some key aspects of energy. These are big propositions that take governments and regulatory approval. Even in some of the fintech and adoptions of cryptocurrencies, this is huge regulatory approval and transition, which just takes time and effort, and nobody can predict how long that is actually going to take. So timing and failure for related to timing is sometimes a really key factor. The other is management teams, and one of my failures was due to a rogue CEO who breached their investment agreement. And to be frank, there's just nothing you can do about that. People are people, and regardless of how much due diligence that you do, sometimes you get it wrong, and there's nothing you can do about it. And another area of failure is too many founders who actually think they are running the company, causing friction. You need a clear leader and CEO. And if you have a number of founders, and I don't advise, and we don't look at, in one instance, we had 5 founders who were all equal shareholders, and it was a disaster. It was an absolute disaster. They could not differentiate between being on a board and setting the corporate strategy, being a shareholder in the company, and actually being employed by the company. And when you have too many founders who are equal shareholders, it causes a lot of friction. So those are just some examples of failures that we've had, and there are many others. Of course, product doesn't work, can't develop the product. It's risk capital if you invest too early. When I look at our existing portfolio and the companies that we currently invest in, we've not had any failed companies. Device Authority was the merger. Device Authority, which is cybersecurity for IoT, full lifecycle management of the IoT device and data, from a software perspective. We combined 2 companies together, to create this entity. Fundamental VR, when you look at surgical training, virtual reality surgical training, very topical, especially in remote COVID world that we exist in. NVMA, industrial IoT, and SaaS product for condition monitoring with our Asset Minder product. Seal Software, which was acquired last year. I mentioned we had one of our companies was acquired. They were acquired by DocuSign for 188 million last year. Unfortunately, we only had a very small equity stake in them. It would have been better to have a bigger equity stake. So it was a very good exit. and talking medicines. And I think, these companies align with our ethos, and it's just to give you an idea of the companies and sectors that we invest in. Talking medicines, which is AI, ML, NLP, organizing highly unstructured data for the voice, to create the voice of the patient for big pharma. Again, very topical in the market. And wild technologies, which is to our topic of discussion, or the question from Anders earlier. Mesh and low power communications for the transmission of secure IoT data using LoRaWAN and satellite, but at the same cost as terrestrial. So, when you look at making an investment in trying to reduce your failure rate, you look at good management teams that are in the right sectors, high growth sectors that have the potential to be highly disruptive on a global scale. And I think when you look at our portfolio, it's very diverse, but companies who have the potential to be really disruptive and market leaders in their respective sectors.
Thank you so much for the answer. Yes, we will leave some time for the audience. Please, Anders. There are two Anders here. Yes, please.
Okay, thank you. Matthew, we kind of have a little bit the same background working with industrial automation. And as you say, also, IoT is nothing new. It's just named that now. But you also visit that we come back to what the timing is so important. Now, I think the technology is ready, which it wasn't 20 years ago. But and also about educating the market. Which market do you think is ready for IoT? Which is educated and was not?
That is $1 million question.
Isn't it just? Yeah, perhaps I should be asking you that question, Anders. Yeah, from your experience.
I'm still searching.
Yeah, I mean, look, I think, hot sectors at the moment, healthcare is without a doubt, anything that you're looking at, IoT, remote patient monitoring, remote analysis, it was coming anyway, but COVID accelerated it and almost forced the hand of remote monitoring of IoT and devices in healthcare. That's not going to go away. That is only going to grow. We have now, set a floor, based on COVID, which will only grow and increase over time. And I think you're already seeing that in the market. Your sector, you'll be happy to know, we like the industrial IoT sector. It still needs some education. You have a lot of, and especially, the large industrial, and industrial players, manufacturers, their digital transformation process is well in progress. And if they're not, they're going to be left behind. They're going to be less competitive in the market, and it will be a challenge for them. The mid-market, which is traditionally more manual, traditionally slower to adopt technology, has legacy solutions, that still takes, needs some work around digital transformation. But, when I look at NVMA, that's where they really win. And to the other Anders question as well, when you look at supporting consultancy businesses with new SaaS technology, new applications, it presents a win-win, because you're taking expertise, digitally transforming to a new way of working that they can actually explain and help them transition to. And for the mid-size industrial IoT, it is, that is a big growth sector over the next 5 years. So I don't know what LifeFinder does, but if you're targeting that sector with the right products, it absolutely is the right space. Clean tech, energy, new president in the White House, everyone's going to, decarbonization goals. It is a hot topic over the next 10 to 20 years, and we are only at the beginning stages. Cybersecurity, the biggest barrier for IoT adoption. So, and nobody's really cracked it yet, because there are so many different avenues and problems and barriers to overcome. We're hoping Device Authority does that, as part of that, solving that problem. But there will be so many other opportunities, and looking at edge, looking at, communication between devices, from IoT devices, using mesh networking and securing those. All kinds of up and coming opportunities in that space. Supply chain, huge disruption potential. Supply chain from, creating efficiencies to IoT sensing, to new energy being applied to those sectors, optimization of very old manual paper-based processes, and lastly, quantum. You're looking at quantum and space tech. I think you've seen two sectors that are highly technical that 3 or 4 years ago were pretty much untouchable, are really now starting to come to the fore and being much more acceptable and mainstream in the market.
Cool. I think Anders Hamber, you have another question.
Yeah, it was related to the venture capital. What you invest in, and my question was like, how much should the company be worth, and how much do you invest?
There's another $1 million question. Evaluation is always highly subjective. Beauty is in the eye of the beholder, Anders. And it has so many different variables involved. It depends on the sector, it depends on the stage, it depends on the scalability, the management team, the status, customers' news.
Okay, but you're saying that you could invest very small and very big, but because my question relates to other kind of ventures capital firms, then that you must be in a certain level and so on.
At our seed stage, we look to invest anywhere from £250,000 to 1.25 million at a seed or early stage. Sweet spot is probably around $750,000, but we will go higher or lower based on all of those factors with the company. Sometimes we tranche, sometimes we don't. It depends on the product. You want to drive the right behavior, but not be too disruptive for the management team. There are other types of fundings. Sometimes we will syndicate, sometimes we won't. With our active operational model, we like to lead because we are working with our companies. So we will want to lead in that seed round stage because we're a partner. We look at it as supporting the management team. From a partnership perspective, that takes some work. And as a result of that, we will generally take a slightly higher equity stake at an earlier stage. But the value that you gain from that is so much more than the equity that you are losing at that stage versus the other forms of fundraising that you will raise. Does that answer your question, Anders?
Very good, very interesting as well. Yes, thank you.
Guys, we're running out of time here. So we will take a 3 minutes break and be back at the 4 p.m. and then we will start with the startup pitching.
Good.
So you
now
guys
I get to ask the questions. I look forward to that. Exactly. So you guys can take a coffee break. Sounds good. Thank you for all the good questions.
Thank you.
Yes, we'll be back.